If you haven't heard it a bajillion times by now, you saw that there's a new COVID strain, and with that brings fear into the market, and we're having a bit of a sell-off. We're talking about the Patreon portfolio and what it's been doing over the past month. It definitely has taken some heat as it is a little bit more focused on growth. And over the past month, we've seen this shift from growth to mega cap companies. Pretty much everywhere you looked, there was red in the markets. The S&P 500, the Dow actually had its worst day yet in 2021, which actually surprised me a bit. But overall, everything was red with this new COVID variant, with the exception of stay-at-home plays like Zoom or healthcare companies like Moderna. If I look at the chart of the S&P 500, we're really not down that much. If you look at the all-time highs, we're down 2.5%, 2%. It's really not that much in the scheme of things. For a couple weeks, trading in a very tight consolidated range, up 1%, down 1%. We didn't really move too much. And I thought that we were a little overcrowded to the long side in the short term, and we just needed some negative news to come out to light the fuse for a down move. And this new strain was exactly that news. Part of the sell-off is obviously related to that, but I'm also thinking that taking some excess out of this frothy market, especially in the short term, is also part of this down move. When it comes to this new strain, obviously I'm not a scientist, so I can't speak technically on what's going to happen. I don't have some crystal ball, but what we can use is previous strains, because this is not the first strain that has popped up since original COVID happened back in 2020. The first variant was back in late 2020 with Alpha, but since then there's been plenty of other variants. Beta, Gamma, Delta, you name it. They're trying to go through the entire Greek alphabet, it seems. But these variants pop up from time to time without missing a beat. Every time the news outlets come out and they fearmonger a bit in order to drive some clicks and get some of that sweet, sweet advertising money. I'm having some serious deja vu because back in July, I made a video where I talk about this exact same thing, and just scanning the first 14 seconds, boom, Delta variant, Dow skids, everyone's afraid. In July, we had a bit of a sell-off. And it's November now, and as of late, I really haven't heard anyone talk about the Delta variant. What I'm trying to say is if you're a positive, optimist person, usually these short-term moves based on fear over the long term don't have a huge impact on the market, but in the short term can cause some volatility. And you can see that with the VIX going up to $28 today. And we haven't seen that since the panic back in the middle of September. And since then, things have calmed, the markets have rallied. And usually, if anything, I put the most weight on the VIX as a time to actually start to scale into positions that are really getting beat up. Unrelated to today's specific news, I want to talk about what's been happening over the past month. I've noticed this divergence between mega cap companies and small to mid cap. If you're heavily invested in growth stocks that are smaller to mid cap, over the past month, you could have been feeling a lot of pain. Something growth companies have to deal with is a rise in bond yields. Back in February and March, we saw a skyrocketing of these yields. Something similar happened to growth companies. They got whacked and then they slowly came back throughout the summer, but the yields started to rise again. Up until today, obviously the yields got hit with a lot of fear in the markets, people rushing into bonds. Before that, yield percentages on the 10-year that was closer to the March timeframe. IWM, which is the index ETF for the Russell, is at the 200-day moving average. The RSI is close to 30. So it's really felt the pain over the past month, and since the beginning of November, it's really just slowly sold off. Whereas with the S&P 500, up until today's bad news and sell-off, it was pretty much at all-time highs. Well, actually, since the beginning of October, pretty much just gone straight up. And that's why sometimes it makes sense to hold on to these mega cap companies. Even though they're already huge, they are still growing, and some of them are at attractive valuations compared to these small growth companies that are trading at extremely high multiples. Unfortunately, hasn't been the greatest month for the portfolio, as I do have a heavier allocation towards growth and also specifically fintech. So I have a heavier weighting towards fintech, and that sector as a whole has been absolutely slammed this past month. Names like PayPal, Square, Visa have really underperformed. A lot of those names have actually taken out some of the alpha that we've been generating. Right now, currently at 6.25%, and the total portfolio is at 60,486. First, let's talk about what I've been buying over this past month. I've actually dipped into a number of stocks. The beginning of the month, buying a little Facebook, and then buying a little bit into infrastructure plays, financial stocks, and then some beaten down growth stocks like Digital Turbine, PayPal, as well as Bumble, just starting a position, and I even added a little bit more to Teladoc. For Disney and Bumble, those are new positions, meaning I didn't already have a position that I'm averaging into. And if you want to see the full analysis of why I bought into those stocks, you can check out either of these videos that I made recently. I know you saw that Facebook buy. I couldn't help myself. It got to around that 320s area, and financially speaking, the company just looked too good for me to pass up on adding just a tiny little bit more. So I'm okay with adding to the position so as long as it's not more than my set percentage at 10%. Ally was one position that I added a little bit more into. After their earnings, they got crushed a bit, not because they had bad earnings, but because of news around an acquisition, which is always interesting to me. In my eyes, long term, if a company is acquiring another company and the stock gets absolutely hammered for it, the stock market is viewing that short term is bad. But as a long term investor, if the acquisition makes sense and they didn't overpay, I don't mind it. So Ally Financial is actually getting into the credit card game, and they're partnering up with Fair Square Financial, and they bought them for $750 million. Around mid-November, Joe Biden signed the infrastructure bill, and part of that was around building out the infrastructure of America over the coming years. I ended up adding a little bit more to Caterpillar as well as Nucor. When it comes to stocks like Digital Turbine, PayPal, Teladoc, all very similar positions in that they're more growth related, especially Digital Turbine and Teladoc. But PayPal falling a decent amount this year after a great 2020 makes sense. I mean, at 300, I wasn't buying. When it fell to around that lower 200 area, definitely interested in PayPal. It's been a long position in the portfolio. Haven't added to it in years, but decided to nibble into a little bit more to get it closer to around 2%. Whereas Teladoc and Digital Turbine, both of those stocks, it's more about getting into a fast growing company for the long term. Some people may be asking, why am I buying the growth if there's expected rate hikes going in 2022? In my opinion, everyone already knows that's going to happen. So the growth stocks have kind of already come down a decent amount. I'm only buying growth stocks that I think the valuations and multiples aren't insane, and I still find the valuation attractive. Instead of going after companies that have price to sales ratios of 50, 60, 100, right? Those are the kinds of stocks I think can fall 50, 60%. And even worse than high price to sales ratio companies are companies like Rivian or these EV plays that literally have zero revenue but are trading at a market cap of $100 billion. As for what I ended up selling, some of this was to just raise cash to buy into positions that I wanted to get into. That'd be VDC, VPU. But some of these were also just getting rid of losers. So Zillow, my thesis had changed when they came out and they stopped iBuying, so I got rid of that. Well, AMD was a pretty small position, so it was just cleaning up the portfolio. Same thing with Fastly, really tiny position. Didn't really want to make it a full position, so just cleaning up the portfolio. And then LMT, they came out with earnings that weren't that great, already a slow grower in the portfolio, and decided to just get rid of the name, clean up the total amount of positions I have across the portfolio. Over the past couple months, we have been able to clean up the positions a little bit, and we're currently sitting at 40 positions, which is still a decent amount. Want to trim that closer to around 30, really move money into higher conviction plays. But we are also getting towards kind of the allocation that I want in terms of stalwarts and fast growers, which I want more of a mix of 40% here, 40% here, and the rest of the 20% spread out wherever I see fit. Also, I am trying to focus a little bit more on growth because I know there may be shorter term pain, but when I'm thinking 5 to 10 years from now, and that's usually the focus, very forward thinking, I want to have some growth positions that may have some short-term volatility, but over the long term can generate some alpha. But there you have it. There's an update on the buy and hold portfolio. If you did enjoy this video, make sure to hit that like button, as well as consider subscribing to Main Street Wolf, where we talk investing, stocks, anything to do with money. Thanks guys for watching, and have a great day.